All right, let's jump right into this explainer. Today, we're tracing the absolutely fascinating evolution of the world's largest private bank, Bank of America. We're going to look at how a century-spanning history, one that's literally filled with earthquakes, hostile corporate takeovers, and massive financial meltdowns, ultimately boils down to one fundamental currency. And surprisingly, that currency isn't the dollar. It's confidence.
So you might be wondering, how exactly did an institution that was originally built to serve Italian day laborers outmaneuver the deeply entrenched kings of Wall Street to become a global empire? I mean, this is the ultimate David versus Goliath narrative. It's the story of an immigrant underdog, and the strategy he used to build this financial behemoth is something you absolutely have to see to believe.
Section 1, the Immigrants' Bank. And this actually starts with a pretty tragic beginning. The story of Bank of America kicks off with a man named Amedeo Giannini. After his father was murdered during a labor dispute, young Amedeo stepped up and took over the family grocery business, working grueling 18-hour days. By the time he hit 31, he'd made the business incredibly profitable, and he was looking for a new challenge. Well, he inherited some local bank stock from his late father-in-law, but when he actually stepped foot into the boardroom, he was totally disgusted. He found the banking industry of that era to be incredibly corrupt and elitist. They were entirely ignoring the hardworking, non-English-speaking immigrants of San Francisco. So Giannini just rejected the norm. He went ahead and founded his own institution, the Bank of Italy, to specifically serve the working class, and he built it entirely on trust and goodwill. And that foundation leads right into a truly incredible defining moment, the catastrophic 1906 San Francisco earthquake. The city is literally on fire. Other banks are completely panicking and freezing their assets, but Giannini acts. Just hours after the quake, he hides his bank's gold and cash inside wagons, cleverly disguised under piles of fruit and vegetables. He evacuates out to San Mateo, and then just days later, he sets up a temporary desk right there on Washington Street. While the city is still smoking around them, he starts offering unsecured loans to devastated citizens based on nothing but a handshake and personal trust. He took a physical disaster and turned it into the ultimate demonstration of financial confidence.
Moving on to Section 2, Battling Wall Street Royalty.
So Giannini figures out pretty quickly that nationwide branch banking is the future. To build out this coast-to-coast network, he aggressively moves into New York. And this sets up an inevitable, massive collision. The West Coast underdog versus the East Coast giant. You've got Giannini, a man of the people who trusted the working class, stepping directly onto the home turf of J.P. Morgan Jr., universally known as Jack. Morgan was East Coast Wall Street royalty. He inherited immense power, was notoriously ruthless in his execution, and he absolutely hated competition. Jack Morgan saw Giannini's expansion into New York not just as a bold business move, but as a direct declaration of corporate war. When the 1929 stock market crash wreaked havoc across the country, Morgan saw his opening. He launched a vicious smear campaign, and he actually successfully crashed the stock of Giannini's holding company, Transamerica. Sensing blood in the water, Morgan loyalists literally ousted Giannini from his own board. They forced him to resign. But Giannini, there was nowhere he was quitting. Relying heavily on his populist, honest reputation, he rallied the everyday common stockholders who genuinely believed in his vision. He pulled off a historic proxy vote win, fired the Morgan loyalists, and victoriously took his empire back. Section 3, the Golden Era of Growth, which brings us to the post-war boom. After throwing its massive financial weight behind World War II, the bank became the largest commercial institution in the world by 1945. Giannini passed away in 1949, and get this, he left a remarkably modest personal estate of just under $500,000. That really proved he was in it for the people, not personal greed. This set the perfect stage for his successor, S. Clark Bies, who looked at the massive post-war economic boom and decided to innovate. 2 million. In 1959, the bank launched the Bank AmeriCard, mailing it out to 2 million California families. This single brilliant move completely revolutionized modern credit, jump-started a brand new era of consumer spending, and absolutely cemented the bank's total dominance in the post-war economy. But, as happens with a lot of empires, the giant eventually stumbles. By the 1970s, the bank had morphed into this massive, complacent bureaucracy. They were just too slow to adapt to change.
Meanwhile, over at Citibank, their visionary and risk-taking CEO, Walter Wriston, made a massive $50 million gamble on a brand new technology, automated teller machines, or ATMs. Because Bank of America seriously dragged its feet on this whole electronic revolution, Citibank was actually able to temporarily steal the crown as the top commercial bank in the U.S.
Section 4. Fending off hostile takeovers. Rolling right into the turbulent 1980s, the bank is really bleeding. Under CEO Sam Armacost, a devastating $95 million loss on a fraudulent mortgage security scheme severely crippled their reputation. The stock totally tanked, which suddenly made them a prime target for corporate raider Sandy Whale. He saw a dying giant that he wanted to control. To save the bank, the board brought back former CEO A.W. Clausen, and he deployed a brilliant defensive mechanism known as a poison pill. Basically, he flooded the market with new shares exclusively for existing stockholders. This wildly diluted the overall ownership percentage, making it astronomically expensive for any hostile acquirer to buy enough shares to actually take control. And you know what? Clausen's aggressive corporate defense, paired with shedding major assets like Charles Schwab, worked flawlessly to save the bank's independence. After crashing down to around $6 a share in the mid-'80s, the stock skyrocketed back up to over $19 by 1988. That made it the world's best-performing bank stock that entire year. They had successfully survived a corporate near-death experience.
Section 5. The 2008 Financial Meltdown. The ultimate systemic crisis.
So throughout the euphoric and 1990s, banking consolidation just went into overdrive. The strict traditional lines between commercial and investment banking were dangerously blurred in this relentless pursuit of unimaginable size. When Lehman Brothers collapsed in 2008, total global market panic set in. Bank of America found itself incredibly burdened by its prior, very toxic acquisition of Countrywide Financial. And to prevent a complete systemic collapse, they were heavily pressured into acquiring a failing Merrill Lynch. The entire financial sector was quite literally teetering on the edge of the abyss.
$45 billion. That is the objective factual price tag of the government bailout provided by the Federal Reserve. Bank of America required this truly massive injection of taxpayer funds just to navigate all those toxic assets and that forced Merrill Lynch acquisition. They emerged from the 2008 crisis severely battered and highly scrutinized, but ultimately they were still intact.
Section 6. The price of an empire. It's all about buying back trust.
Fast forward to 2011, and the bank is reeling from internal disputes. The new CEO, Brian Moynihan, looked at this bruised, giant institution and realized that capital alone wasn't going to save them. They desperately needed an ultimate signal of trust to stabilize their plummeting reputation. And they got it, $5 billion. But it wasn't just any $5 billion. It was a massive cash injection from legendary investor Warren Buffett. What's absolutely crucial to take away from this is that Moynihan wasn't just acquiring cash. He was buying back credibility. Buffett's huge investment was a very public vote of confidence, signaling to the entire market that Bank of America was in fact going to survive.
And this really brings us full circle to the core theme of our explainer. The banking business is all about confidence. Whether it's Amedeo Giannini handing out unsecured loans on a makeshift desk in the smoking ashes of the 1906 earthquake, or Brian Moynihan securing a multi-billion-dollar lifeline from Warren Buffett in the brutal fallout of 2008, the singular driving force that keeps any bank alive is trust. So what does this empire look like today? Well, the modern behemoth is a bit of a dual reality. On one hand, you have staggering successes, incredibly strong earnings, a highly successful digital transformation, and increased dividends for their shareholders. But on the other hand, you have the immense weight of its own bureaucracy, ongoing consumer complaints regarding fraudulent transactions, excessive fees, and severe issues with regulatory non-compliance that have resulted in massive fines. It's a reality of incredible financial power living right alongside deeply rooted operational friction. Which leaves us with one final, pretty provocative question to think about. We've seen how this institution was born from an immigrant underdog's deep desire to serve the working class fairly. But today, looking at the sheer massive scale and the ongoing regulatory friction, we have to ask, can a corporate Goliath of this unimaginable size ever truly return to Giannini's simple, trust-based mandate of just doing right by the customer? It's a question of whether the relentless pursuit of endless growth ultimately sacrifices the very confidence a bank was built on in the first place. Thank you so much for joining me for this explainer, and I'll see you next time.